the biggest things that trips buyers up when they're buying a home is feeling like they have to learn a whole other language, so that they need to speak lender lingo, mortgage terms, and understand all those details. So I wanted to explain to you some common mortgage terms so you understand what's going on and you don't feel like you have to look everything up just to have a basic conversation. The first one is APR, or annual percentage rate. And what it sounds like is that it's a complicated rate, or you're going back to math class. So what an APR actually is going to be the total cost of your loan. So it's going to take your interest rate, your note rate, the rate that your payment is based off of, plus your loan cost, and then calculate what that rate would be over the terms of your loan. So for example, if you have a 30-year loan, it's going to be as if you financed those loan costs over 30 years and what that would mean for what the rate would actually be. So again, from a calculation standpoint, it doesn't make a whole lot of sense, but what it does tell you is it tells you essentially not just the rate that you're getting, but how much you're paying to get that rate. And it's a good idea to compare APR to APR if you are looking at different options to really understand, is this worth it to maybe pay more loan cost for a lower rate? Because it's, again, not just about the rate that you're paying, it's what you have to pay to get it. Second term is escrow, and it kind of sounds like it's a secret account or something. All it really is a holding account. So it's a savings account. It's non-interest bearing, meaning your lender doesn't make money off of it, but it is a account that is attached to your mortgage that holds your reserves for taxes and insurance. So every month when you make your payment, if you have an escrow account, and that usually is required if you're putting less than 20% down on a conventional loan, or if you have a government loan like FHA, VA, USDA. But every month when you're making your payment, your tax bill and your homeowner's insurance bill will be divided by 12, and that's included in your mortgage payment. That amount that you're paying every month, it's kind of like forced savings, basically. But what you're doing is you're putting a 12th of that payment into the escrow account. So when your tax bill or when your insurance bill is due, it gets paid from that account, and you're not hit with a couple $1,000s in a tax bill or insurance bill. Now, debt to income, or DTI. It kind of sounds like an algebra problem, but what it is there are going to be two numbers that a lender looks at when they are qualifying you for a loan. Your housing DTI, or debt to income ratio, and then your total debt to income ratio. That's taking your total housing payment, taking principal, interest, taxes, insurance, and HOA if you have one, and dividing that by your gross income, or your before tax income. Then we're also going to look at that housing payment plus any monthly debts that you have. It's going to be things like auto loans, student loans, credit card payments, any other real estate. It doesn't include things like your utility bills or things along those lines, but those two debt to income ratios do matter because different loan types have maximum DTIs that they will allow. All right, so the other one is PMI, or private mortgage insurance. And PMI, or mortgage insurance, is usually going to be needed if you are getting a conventional loan and you're putting less than 20% down, or you're getting an FHA or a USDA loan. They're called slightly different things for FHA and USDA, but essentially it's mortgage insurance. So it might sound like it's a penalty, it might sound like it's a junk fee, but really when you're looking at what PMI does, is it is a way to leverage money. Because without PMI, we wouldn't have FHA as an option with 3.5% down. We wouldn't really have USDA. We would have conventional with 20% down, which means a lot of people would not have options to buy a home. So what PMI is it covers the lender in case there's a foreclosure. So the more you put down, typically the less that the mortgage insurance is. But again, it is not a junk fee. It does cover the lender from the standpoint of having a little bit higher risk. Trade-off is you have a lower down payment. Another one is pre-approval. And it sounds like it's a golden ticket. Here's what it really is. When a pre-approval is done well, that means that a lender has looked at not only just your credit report, but they've also looked at your income documents like pay stubs, W-2s, tax returns. It also means that they have looked at your asset accounts in terms of your checking, savings, 401k, gifts, wherever the down payment is coming from, to make sure that not only do the numbers work from the standpoint of the application that you turned in and what you said that you make and what you say that you have, but making sure that we're looking at those numbers from the standpoint of how your income is going to be calculated once we get into underwriting guidelines, and then also making sure that the source of the down payment works for underwriting guidelines. So a pre-approval is essentially saying, as a loan officer, I have looked at everything that you can provide me to this point, and things look good up to this sales price or up to this payment. And then that pre-approval moves into an official loan approval, and we get all the property information like the appraisal, title work from the attorney, and all of that. It's essentially a lender's thumbs up to put in an offer on the home. It's not a guarantee, but it is necessary to make sure that you understand what budget to look in and understanding what loan type and how your loan process is going to go. Another one is a rate lock. And that might sound like it's like a trick, or it's just from the standpoint of you are locking in your rate. And that is what you are doing. In most cases, you are able to lock your rate once you go under contract. So the benefit of doing that is you know exactly the rate that you're going to have for your loan. You also know how long that rate is locked for. So if you're going to close in 30 days, you would have a 30-day rate lock, versus if you had a longer timeline, then you're going to need to lock that rate for longer. How it helps you is that way you're not exposed to the market. So even if rates go up while your loan is still being worked on and your loan is being finalized, you're still protected because that rate has already been locked in. Your terms are already set. Title insurance. It sounds like it's probably just another fee or another junk fee, but here's what it is. There is both lender's title insurance and buyer's title insurance. And it's protection in case somebody claims that they have a right to your house, or that there is a permanent structure like a building or maybe even a fence or anything like that that is across the property lines, which is called encroachment. But essentially what the title insurance is there to do is to help make sure that in case there's ever any kind of dispute for the ownership or property lines, that both the lender's interest, your loan, is protected, and that your interest in the property, your equity, is also protected. It's not something that you pay every year like homeowners insurance. It is a one-time charge that is paid at closing. Lenders do require that you pay for title insurance. The buyer, you can opt to pay for title insurance or waive it. Most of the time, most buyers will go ahead and pay it because it's fairly cheap, and then that way you have the protection and you don't have to worry about anything. And finally, underwriting. This is where it sounds like they judge you, or that the underwriter is out to just give you a hard time or find a reason to make the loan not happen. And that's truly not what they are there for. They are there behind the scenes to make sure that everything that you've provided matches loan guidelines, that you can be approved for that loan. So when the pre-approval, to bring it back, when the pre-approval is done well, then underwriting is a breeze. And we're just updating some information, maybe a new pay stub, possibly showing updated bank statements, those kind of things. But it's again there to make sure that all the different pieces and parts of the loan, everything from your details, but also the property to the property history, that everything is as it needs to be, so final loan approval can be given. And know that there is a lot of lender lingo when it comes to getting a mortgage. The best thing to do is, if you hear a term that you don't understand, just ask, because our job as a loan officer is to make sure that our buyers understand what's going on so they can make confident decisions. If you found this helpful, please be sure to subscribe and like and comment, and I'll see you next time.